You've seen it happen, right? One week, the crypto market is a sea of red and everyone's panicking. The next, it's bouncing back. But have you ever noticed what happens during those downturns? It always feels like that's the exact moment powerful institutions start piling on the negative pressure, kicking crypto wallets down. So today, we're digging in to figure out if the latest wave of bad news was just a coincidence or something a little more calculated.
So that's the big question on the table. When prices take a nosedive, is it just the market doing its thing, a simple correction? Or are some very powerful players in finance and politics making a coordinated move, using the downturn as a chance to strike? It really feels that way sometimes. So let's break down the evidence and see what's actually been going on.
All right, first up, let's talk about the big Tether controversy. We've got S&P Global Ratings, and these guys are absolute titans in the world of financial analysis. And just as the market started to get wobbly, who did they decide to take aim at? Yup, Tether, the biggest stablecoin out there and basically a cornerstone of the entire crypto ecosystem. And just look at this quote. They're downgrading it to weak and calling it dangerous for the markets. Wow, that is not just some small warning flag. S&P didn't just, raise an eyebrow here. They came out swinging, calling Tether flat out dangerous. A statement like that is designed to send shockwaves through the whole space. So what was their reasoning? Why make such a dramatic claim? Okay, so here's what S&P's official argument boils down to. It's all about risk. They pointed their fingers squarely at Tether's Bitcoin holdings, calling them high-risk assets. Their whole point was, hey, if Bitcoin's price crashes, Tether's stablecoin, USDT, might not have enough backing anymore. And they throw out this big, scary number, $5.6 billion in Bitcoin exposure, as the main reason everyone should be worried. But this is where things get really, really interesting. You start to see this huge gap between what S&P was claiming and, well, reality. S&P is screaming about the risk of their Bitcoin holdings. But hold on. Tether's side of the story is that they bought most of that Bitcoin for an average price of just $19,000. You can literally go check their public wallet, and it shows those holdings are now worth closer to $8 billion. And maybe the biggest head-scratcher of all, S&P's analysis seems to have completely glossed over Tether's enormous stash of gold and US Treasuries. Kind of important details to leave out, don't you think?
So as you can imagine, Tether didn't just sit back and take it. They fired back hard. They basically called out S&P for using a totally biased framework, arguing this wasn't just some oversight, but a calculated hit piece to protect traditional finance. And they brought receipts. They reminded everyone that they are one of the biggest holders of US Treasury bonds on the planet and that they buy more gold than some actual countries. Just a few minor details S&P forgot to mention when they were labeling them as dangerous.
Okay, but the plot thickens. We're moving from finance to politics now. Because get this, on the exact same day that S&P dropped its bombshell report on Tether, a report from the US Democratic Party suddenly appeared, adding a whole new layer of political heat to the fire. And this wasn't some light political jab either. The report leveled a really serious accusation. It claimed that the Trump administration had actively interfered with federal investigations into crypto companies, specifically companies that had made donations to the president. And they didn't stop there. The report went on to claim that former President Trump actually used his presidential powers to pardon and cancel sanctions on what they called known malicious actors in crypto, all because they had supported him financially. So you can see why the timing of this, dropping on the same day as the S&P report, well, it definitely made a lot of people raise an eyebrow. But of course, there are two sides to every story. And the counter-narrative here flips this whole thing on its head. It says, look, the problem isn't just what Trump might have done. The real issue is that the current administration is creating total chaos by refusing to give the crypto industry any clear rules to follow. And this right here gets to the absolute core of that argument. People on this side say crypto companies have been begging the SEC for clear rules for years, and they've just been ignored. Instead, what does the SEC do? They use a strategy of regulation by lawsuit, basically just attacking the industry with lawsuits over vague definitions of unregistered securities. And get this, they point out that Democratic SEC commissioners actually voted against the Bitcoin ETFs, even after a U.S. court ordered them to approve them. The argument is that this total lack of clear rules creates a Wild West environment where both bad actors and government overreach can run wild.
So let's just recap for a second. You have a major ratings agency and a major political party hitting crypto with a 1-2 punch, all at the same time. You'd think the market would just collapse under that kind of pressure, right?
Well, that's where the story takes a really surprising turn.
Because right as all this bad news was hitting the wires, something else was happening in the background. A massive $6 billion wave of stock buybacks in the S&P 500. That's a huge injection of cash that just boosted confidence across the board, not just in stocks.
And you could see that confidence in the VIX. That's the market's so-called fear index. It dropped all the way down to 17. What does that mean? It means that despite all the scary headlines, investors were actually getting less fearful, not more. And then you had a classic short squeeze. The most shorted stocks, the ones everyone was betting would fail, suddenly shot up a whopping 17% in just 1 week. That's a crystal clear sign that investors weren't running for the hills, they were ready to take on risk again. But here's the real kicker, especially for crypto. With all of this negativity aimed directly at it, what happened? Crypto investment funds actually saw a net inflow of $21 million. After weeks of money flowing out, it started flowing back in. It just goes to show how incredibly resilient this market can be.
Okay, so where does all this leave us? On one hand, you have these incredibly powerful institutions applying what looks a whole lot like coordinated pressure. But on the other hand, you have the market itself just shrugging it off and pushing back with some serious force. This is what's setting the stage for the real battle ahead.
And really, this is the main takeaway. What we're watching play out is a massive tug-of-war. You've got the top-down pressure from institutions and politicians who seem determined to control or even crush the industry. And then you've got the bottom-up power of the market, driven by investors who just refuse to back down. It's an incredible dynamic.
So that leaves us with the big multi-billion-dollar question, doesn't it? The battle lines are drawn, new laws are coming, that's for sure. But will they finally bring the clarity that everyone in the crypto space has been asking for? Or will they just become another weapon to create more chaos and maintain control? How that question gets answered is going to define everything for crypto moving forward. If you found this explainer helpful, be sure to smash that like button and subscribe so you don't miss your next daily edge. More news in our Telegram channel in the first comment. See you next time.